Have you noticed how everyone talks about age 59 and a half, 62, 65, or when required minimum distributions begin? Yet almost nobody talks about age 70 and a half. And that's surprising because this is the exact age when several powerful tax opportunities become available. Opportunities that many retirees never use simply because they don't know they exist. Over the years, I've spoken with retirees who worked hard, saved diligently, and still ended up paying far more tax than necessary. Not because they made mistakes, but because nobody explained how the rules change after age 70 and a half. Today, we're going to walk through 7 important provisions that become available at this age and how they may help reduce taxable income, improve retirement tax efficiency, and potentially protect more of your Social Security benefits. As always, this video is for educational purposes only. Tax laws change, individual situations differ, and you should always consult a qualified tax professional before making financial decisions. Let's get started. 1. Qualified Charitable Distributions, QCDs. If you're age 70 and a half or older and you give money to charity, this may be one of the most valuable retirement tax strategies available. A qualified charitable distribution allows you to send money directly from a traditional IRA to an eligible charity. The key benefit? The distribution generally doesn't count toward your taxable income. That means the money can potentially avoid increasing your adjusted gross income, which may help with several retirement tax calculations. For retirees who already donate regularly, the difference can be significant. Imagine 2 people giving the same amount to the same charity. One withdraws money from an IRA, pays tax on the withdrawal, and then donates. The other uses a QCD and sends the money directly from the IRA to the charity. Same donation, same charity, different tax outcome. That's why many retirement tax professionals consider QCDs one of the most efficient charitable giving tools available. A common mistake is having the money sent to your personal account first. For a distribution to qualify, it generally needs to move directly from the IRA custodian to the eligible charity. If charitable giving is already part of your retirement plan, this is definitely worth discussing with your tax advisor. 2. The one-time QCD opportunity for certain charitable income arrangements. Recent legislation created an additional option that many retirees have never heard about. Eligible individuals can make a one-time transfer from an IRA to certain charitable income arrangements, subject to applicable limits and IRS rules. Why does this matter? Because some of these arrangements may provide income payments while also supporting charitable causes. For retirees who are already philanthropically inclined, this can create a unique combination of charitable impact and retirement income planning. This isn't a strategy for everyone, but for the right situation, it can be an option worth exploring with a qualified professional. 3. The pre-RMD planning window. One of the biggest opportunities after age 70 and a half is something many people completely overlook: the years before required minimum distributions begin. Think about it. Once RMDs start, the IRS determines a minimum amount that generally must be withdrawn each year. But before that happens, you may have greater flexibility. This planning window can allow retirees to evaluate charitable strategies, tax planning opportunities, and long-term distribution decisions before mandatory withdrawals begin. In my experience, retirees who use these years intentionally often have more options later than those who simply wait for RMDs to arrive. The earlier planning begins, the more flexibility you may have. 4. The final years of the Roth conversion opportunity. Another major planning opportunity during this period involves Roth conversions. Many retirees spend years building traditional IRA balances. The challenge comes later when withdrawals become taxable. A Roth conversion moves money from a traditional IRA into a Roth IRA, creating a taxable event today in exchange for potential tax-free qualified withdrawals later. The years before RMDs begin are often considered some of the most favorable years to evaluate this strategy because income levels may be more controllable. Once RMDs start, planning becomes more complicated because mandatory withdrawals enter the equation. Every retirement situation is different, but if Roth conversions are something you've been considering, the years after age 70 and a half may be among the most important years to review the math. 5. Improved QCD reporting. Many retirees have been frustrated by one issue over the years: properly reporting qualified charitable distributions on tax returns. Fortunately, reporting procedures have improved. The goal is simple: make it easier for taxpayers and tax professionals to identify qualifying distributions correctly. While this may sound like a small administrative detail, accurate reporting helps reduce confusion and supports proper tax filing. It's a reminder that even excellent tax strategies only work when they are documented correctly. 6. Managing the tax impact of Social Security benefits. By age 70, many retirees have already claimed Social Security. At that point, the conversation often changes. The question is no longer, when should I claim? Instead, it becomes, how can I manage the tax impact of the benefits I'm already receiving? This is where income planning becomes extremely important. Different income sources can affect retirement taxes differently. Traditional IRA withdrawals, Roth distributions, investment income, and charitable strategies may all influence your overall tax picture. The goal isn't necessarily to eliminate taxes. The goal is to make informed decisions so more of your retirement income stays working for you, instead of disappearing unnecessarily. I've seen retirees spend decades building wealth, but only a few hours planning withdrawals. Yet withdrawal strategy can be just as important as investment strategy. 7. Combining available retirement tax benefits. One of the most overlooked concepts in retirement planning is that powerful strategies often work better together than individually. For example, a retiree may be eligible for deductions, charitable giving strategies, Roth assets, and Social Security planning opportunities all at the same time. Individually, each strategy can help. Combined, they may create a much stronger overall outcome. The most successful retirement plans I've seen aren't built around a single tax move. They're built around coordinating multiple rules that already exist. The challenge is that very few people ever see the full picture. They hear about one rule here, another rule there, but nobody shows them how the pieces fit together. And that's where careful planning can make a meaningful difference. Final thoughts. Age 70 and a half may not receive the same attention as other retirement milestones, but it remains one of the most important planning ages in retirement. At this stage, you may have access to qualified charitable distributions, specialized charitable planning opportunities, a valuable pre-RMD planning window, potential Roth conversion opportunities, improved reporting procedures, Social Security tax planning strategies, additional ways to coordinate retirement tax benefits. The key takeaway is simple. The IRS rules change, and retirees who understand those changes often have more options than those who don't. If you're age 70 and a half or older, consider reviewing your current retirement income strategy with a qualified tax professional and see whether any of these opportunities may apply to your situation. And now I'd love to hear from you. Which of these 7 provisions was the biggest surprise? Comment below with the number that stood out most. Thanks for watching, and I'll see you in the next video.